Dear student or learners, I am going to start more important chapter, that is a ratio analysis. I am spending more time giving more class because it is the most important chapter, not only for 12th class, for honors classes, master degree, professional degrees, all classes everywhere in the practical life, doing the job, at the time of market analysis or financial analyzer, everywhere in company, in the market, everywhere there is a importance of the chapter, that is knowledge is required regarding the ratio analysis. It is the analyzing part, it is the analysis part. I have already discussed there are 4 types of ratio. One is current ratio, that is solvency ratio, that is liquidity ratio, then solvency ratio, then turnover or activity ratio, and 4th one is profitability ratio. Now we are still doing the solvency, that is in the solvency there are 4 ratios. One is debt equity ratio, another is total asset to debt ratio, and proprietary ratio and interest coverage ratio. We have spent classes, 2 classes, one on debt equity, another in total asset to debt ratio. Also we have done 1 classes for proprietary ratio, but I am going to start today interest coverage ratio. What is interest coverage ratio? Interest coverage ratio equal to the net profit before interest and tax by fixed interest charges. Fixed interest may be on bond, may be on debenture, may be on loan, which the company is paying as interest. The net profit before interest and tax, profit before interest and tax, profit before interest and tax, PBIT, by fixed interest charges. So what is the importance of this? If I take any loan, I have to pay interest, and thereafter we have to repay the entire amount. First, the ability to pay the interest have to judge first. The company is able to pay the interest or not. That means one person is giving loan to this organization, they should check, are the companies able to pay the interest when debenture holder is purchasing the debenture from the company. First of all, he or she should check the ability to pay the interest from debenture of the company. Thereafter, they will make the investment in the company and will purchase debenture. So, significance of this ratio is, what is the significance of the ratio is, it reveals the number of times, it reveals or express the number of times interest on long term debt is covered by the profit available. Profit available means PAT, profit before interest and tax. How much time it can cover the interest portion? How much time giving the coverage? That is, higher ratio indicates the safety of interest or long term debt. When someone giving some loan to the company long term, and this organization or the person first of all justify or check up the interest coverage ratio or analyze, because the ratio analyze the interest coverage ratio. It reveals the number of times interest on long term debt is covered by the profit available, and profit means profit before interest and tax, and A higher ratio indicates safety or interest on long term debts, and there is a small comments on this. Acceptable coverage, interest coverage ratio, it means 6 or 7. If it is 6 or 7 in the interest coverage ratio, that means the profit before interest and tax is the 6 or 7 times of the interest payable. So, it is the more or less norms, it is not norms, it may be the acceptable, it is the acceptable position or the acceptable norm. It is 6 or 7 times of the interest. Profit should be 6 or 7 times of the interest payable. Now, I am expressing another thing here, the ratios. It may be liquidity, it may be solvency, it may be activity or turnover, it may be profitability. Whatever will be the ratio can be pure ratio, that is can be expressed as pure ratio, that is only quotient. Quotient means 100 by 20, 100 by 20, that is 5. The 100 by 5. What is this? Equal to 20. That means only quotient form we can express in the quotient form. Only quotient. That means this by this divided by this, the quotient form. Otherwise, that means it is used quotient form or the current ratio. Current asset and current liabilities is always expressed in terms of quotient, and current ratio equal to 2:1. That means current asset is to be doubled of the current liabilities. That means it is expressed in the quotient form. Now the percentage form, like gross profit ratio, net profit ratio, net operating ratio, return on investment, everything is expressed in terms of percentage. That is, percentage method is used particularly this. Sometimes that means expressed, the ratio can be expressed in times also, maximum times. The activity ratio or turnover ratio are expressed in terms of times. That is, inventory ratio, it may be 2 times, it may be 3 times, it may be 4 times inventory ratio. Then sometimes in the fraction form, that is numerator by the denominator, whatever the result, the fixed asset of business and non-current asset. That means it may be 5 by 2 or 3 by 2, it is the called fraction. It is the time, it may be 3 times or 4 times form. It is percentage, it may be 20% or 30%, that is percentage, and it is the quotient form. Then numerator by denominator, we will get a quotient. That is, there are 4 forms, that is pure, that is the quotient form, then percentage, it is this, then times and fraction. Now, I have already discussed in this class, that is solvency, these and these, inventory coverage ratio formula, their significance and the comments on this. If it is a higher ratio, indicate the safety. So, obviously, lower ratio indicates unsafety. It is, and comments acceptable or norms is 6 or 7 times. Now, we have taken a very interesting small problem, that is, we have to calculate the debt equity ratio, interest coverage ratio and proprietary ratio. There are, if data is given from the data, we have to calculate this one and this one first. Data is given, I am reading the data one by one is given, I will go slowly for this. That is, equity share capital is 2 lakhs. Then preference share capital, it is 60,000. That is general reserve, it is 1,20,000. Then fixed asset, 5,05,000. then current asset equal to 1,20,000, then current liabilities equal to 40,000, 10% debenture. That means on 5 lakh debenture we are paying interest, or the company or the organization paying interest at the rate of 10%. That means every year the company will pay 50,000 interest on debenture because it is 10% debenture. Now it is 5% preference share. In case of companies earning profit, profit is available. First of all, preference shareholder will give certain dividend at the rate, that is rate is fixed here, preference share. They will get the preference 5% preference share capital. It is 60,000. General reserve 1,20,000 and fixed asset equal to how much? 5,05,000 and current asset equal to 1,20,000 and current liabilities is 40,000. 10% debenture, interest bearing debenture is 5 lakhs and tax paid 30,000 and profit is after tax, it is paid. Profit after tax is 90,000. Paid profit after tax is 90,000. Now we are now doing, or I am doing the problem before all of you. You will get more clarity. It is more important chapter in the commercial life, for investment in the share market, in the school, college, university, financial institution, company. It is a very practical topic. It is too much needed in the commercial society. Everywhere it is most important chapter. So not only for class 12, for class honours or master degree and other professional degree, it is the most important chapter. So now first of all, debt equity ratio, that is this one, equal to debt by equity. Debt means long term debt by equity. What is long term debt here? Long term debt here is debenture. It is a long term debt. How much? 10% interest bearing debenture, 5 lakh. It is a long term. Then equity. Equity is equity share capital, preference share capital, general reserve. GR stand for general reserve, GR, and PAT, profit after tax. Profit after tax is PAT is 90,000, profit after tax. So if we add this plus this plus this plus this equal to 4,70,000 equal to what? Equity. And we have already mentioned debt is the long term debt. In the given data only there is a long term debt of 5 lakhs, 10% interest bearing debenture. So that is now these by these 5 lakh by 7,70,000, 4,70,000, it comes to 1.01 by 1, that is this. The now we can write it this equal to this. This is to this. We have got the result. Now second ratio is mentioned here. Today's topics here to learn the interest coverage ratio. What is the capacity of this organization or the entrepreneur or the company? How much the capacity? That means the how many times is profit available to pay up the interest on long term loan. So interest coverage ratio equal to net profit before interest and tax, that is profit before interest and tax equal to here, that is we have to calculate profit before. We have got profit after interest and tax. Interest is debenture 5 lakh and 10% is interest, that is interest on debenture equal to, it is this, interest on debenture is this and tax is this. this equal to 1,70,000. 90,000 is the PAT profit after tax. Then interest, we have to calculate, we are going to calculate profit before interest and tax, that is interest 10% on the debenture equal to 50,000 and tax paid by the organization or by the company is 30,000. So, profit before interest and tax 1,70,000 and interest on long term loan, that is only debenture here, 5 lakhs into 10,000, 5 lakhs into 10% this equal to 3.1, that is 3.1 by 1, that is you can write 3.1 is to this, you can write this interest coverage ratio, or you can write 3.4 times, there is no problem, 3.4 times. Now, in the last class, we have done the proprietary ratio, that is this one. Again, through this sum, we are doing this problem or calculating proprietary ratio equal to, we have learned the last class, equal to shareholder fund by the total by total asset. That means how much is the shareholder holding out of the asset, that is equal to 4,70,000. We have already calculated here, that means shareholder fund, that is equity, equal to 4,70,000. Now, the total asset equal to current fixed asset plus current asset. We are adding fixed asset equal to how much? 5,50,000 is the fixed asset, 5,05,000 equal to fixed asset and current asset equal to, what is the current asset? 1,20,000, that is we are getting 4,70,000 by upon 6,25,000 we are getting 0.75 by 1, that is we can write 0.75 is to 1 is the ratio, proprietary ratio of this organization. I am now concluding the class, and this chapter will be continued in the next class also. Thanks all of you.